The United States imported $525 billion in goods from China in 2024, while exporting only $164 billion back. Washington points to this massive $361 billion gap as proof that unfair subsidies and forced technology transfers have stripped the American market of its manufacturing base. Beijing counters that the U.S. trade deficit is a byproduct of low domestic savings and high consumption. The United States imported $525 billion in goods from China in 2024, while exporting only $164 billion back. Washington points to this massive $361 billion gap as proof that unfair subsidies and forced technology transfers have stripped the American market of its manufacturing base. Beijing counters that the U.S. trade deficit is a byproduct of low domestic savings and high consumption. They view American tariffs as illegal protectionism designed to suppress a rising economic competitor. This friction first broke into the open in 2018, with the U.S. imposing blunt force tariffs on specific sectors like washing machines, solar panels, and steel. Rather than correcting the trade imbalance, these targeted measures ignited a cycle of retaliation that has since expanded to encompass nearly every category of bilateral trade. China's first retaliatory measures hit the American heartland, causing U.S. soybean exports to drop by 75%. A 2020 truce briefly stabilized the relationship, but the underlying trade barriers remained in place, even as the global pandemic shifted sourcing patterns. By 2025, that temporary stability collapsed, pushing trade-weighted averages back into the triple digits. Consider a $35,000 electric vehicle manufactured in China. A 25% tariff adds $8,750 to the sticker price. The manufacturer receives the same amount. That extra tax is paid by the American consumer and flows to the U.S. Treasury, while Chinese production costs remain unchanged. Because tariffs tax consumption rather than addressing the gap in global labor costs, they have historically failed to drive a significant return of manufacturing jobs to American soil. Beneath the physical trade of goods lies a more complex struggle over the flow of capital and the value of currency. The U.S. accuses China of currency manipulation, claiming Beijing deliberately keeps the yuan weak to ensure its exports remain the lowest-priced option on the global market. Washington's strategy is to pressure China to let its currency strengthen, similar to the 1980s policies that forced Japan to face a stronger yen. A more expensive currency would make Chinese exports less competitive, potentially trapping their economy in a cycle of slowing growth and deflation. Beijing has refused to follow that path, instead accusing the U.S. of manipulating its own currency by printing trillions of dollars to finance its debt. This creates a unique dynamic for the American economy. Because the U.S. dollar is the global reserve currency, capital from around the world flows back into U.S. stocks and debt during times of global instability. This sustains American financial growth, despite trade barriers. While the U.S. leverages the global need for its currency and capital markets, China leverages its dominance over the world's physical supply chains. Data from the last 7 years suggests that tariffs haven't rebuilt the domestic factory floor. At current U.S. labor rates, an iPhone manufactured entirely in America would cost an estimated $2,400. Instead of stopping, trade is simply rerouting. Chinese components and assembly are moving through third-party countries like Vietnam and Mexico to bypass the tariff walls at the American border. China is now using its own leverage by restricting the export of rare earth metals. These minerals are essential for high-tech manufacturing and defense, and China currently controls the vast majority of the global supply. The two economies are not truly separating. They are becoming more distantly connected through longer, more expensive, and more fragile supply lines. Beijing is responding by propping up its own markets and pivoting its trade toward the global south. The goal is to position China as a stable alternative to the United States in a multipolar world order. The United States retains massive leverage as the world's primary buyer, but history shows that trade wars are far easier to initiate than they are to resolve. We are seeing the fragmentation of a once unified global trading system. The seamless flow of goods that defined the last 30 years is being replaced by a system of silos. The result is a bifurcated world. One economic orbit is centered on American capital and consumption, while the other revolves around Chinese industrial production. For consumers, this shift means that the era of low-cost, high-speed globalization has likely ended, replaced by rerouted goods, higher prices, and the strategic use of global